Meanwhile, I request my audience to share the links to these spaces with their friends and family so that they can benefit from the experience of Ritesh sir. And definitely, this is going to be one of a session wherein we'll be discussing around the topic and the global macros and try to see where we are positioned as on today. So I would sincerely request, so kindly share within your circles. So, guys, let me take the opportunity to welcome Ritesh Jain, sir. We are hosting him for the second time, and his first session is already available on my YouTube channel. Definitely worth listening to, and that would be in continuation on the same topic. And sir has started a very good YouTube channel of his own, and that is why his new venture is founder at NRIZEN,
NRIZEN.
and yeah, sorry, my bad. So basically, we'll be knowing from Ritesh sir more about it, and he is also founder at Pinetree Macro, and sir has got 20 plus years of rich experience in different roles in the market. He has managed domestic as well as offshore funds, and he's known for his acumen of global macros, which we'll be discussing in today's session. So, Ritesh sir, over to you. I would appreciate if you tell a little bit about your new initiative, and then we prefer opening note about the topic, and then I go on with the questions, and later we can open the forum for our audience if they have any questions. Over to you, sir. Thank you.
Great. Thank you so much, Prince. So, just a couple of things about what I'm currently doing. I started Pinetree Macro 1.5 years back. It is an asset allocation product for Indians who wants to invest globally. So they can invest in that product. The minimum investment is $100,000, so you know that it is for HNIs, but that is because of the regulation part. The fund is now 1.5 years old, and every month I post fact sheets. The performance is available on Pinetree Macro website. Unfortunately for today, Pinetree Macro website is down because of some issue. But you can see the performance of Pinetree Macro over there. I started 3 months back. I started NRIZEN. NRIZEN is a platform for NRIs, and honestly, even Indians can invest. But it is platform for NRIs to invest in India, in Indian capital markets, basically mutual funds. The simple reasoning of starting NRIZEN was again a macro call. Bear with me when I explain you a couple of times, a couple of minutes on that. Historically, NRIs have been investing in Indian real estate, and they have shied away from investing in Indian capital markets. The reason was very simple. Indian currency used to depreciate, and in a depreciating currency versus G7 currencies, okay, the real assets do better than financial assets. I believe going forward, even now also, most of the G7 currencies are not appreciating against INR, except for maybe USD, okay? And incrementally, money in India will not be made through currency depreciation by the people staying in these G7 currencies, these NRIs. Secondly, these economies are in a very bad situation where, you know, the promise of you having a pension after retirement is no more given. I believe a huge amount of NRI money is going to be looking to participate in India growth story over the next few years, and hence NRIZEN as a platform for NRIs to invest in India. So anybody can go on NRIZEN. They can even schedule a meeting with me, and they can invest. And I have also created a basket of mutual funds over there based on my macro view. We gave it to an outside agency which has just come back to me, and that URL will be available on. I will be sharing their views on my curated portfolio in the next couple of days, where they say most of the curated portfolios which I put over at NRIZEN outperform the benchmarks by a huge margin. So that I will do separately. But let's dive into what you are here to listen today. Friends, we can start,
Great, sir. So we start with the global liquidity view and what could be the possible consequences in present day situation.
Okay, first of all, let me take you through a history of global liquidity and bubbles. It is important for us to understand how it has happened over the last 20, 30 years. Once you understand the history, you'll be able to connect the dots in your mind. Okay, you'll be able to look at it from a completely different angle. 1987-89 was a period of Japan bubble. And it happened because Japan, due to Plaza Accord, had to agree to appreciate its currency, and huge amount of capital went into Japan. And at one point of time in 1989 or 1990, Imperial Palace of Japan was valued more than the entire Manhattan real estate. That was a bubble. Why did the bubble burst? Because US Fed increased its rate from 7% to 10%. So whenever Fed increases the rate, it actually hurts somebody. It kills some bubbles. It's a very simple thing. Then after that, the Gulf War started in 1990. I'm pretty sure you'll remember. At that point of time, US Fed eased monetary policy again, and the dollar started depreciating. Capital moved into emerging markets and inflated asset prices, creating a bubble, which finally culminated into an Asian crisis in 1997. So this time the Fed started tightening policy at the end of 1994 and raised rates from 3% to 6%. As usual, monetary policy, you know, that works with a lag effect, and the Asian bubble burst in 1997. Now, bursting of EM bubble and LTCM crisis led to Fed again easing policy for a short period of time. This time the beneficiary were tech stocks. Remember that Y2K bubble? Beneficiary were tech stocks which got the added benefit of Y2K related excess liquidity, thereby inflating their valuations. The bubble burst in 2000. I'm pretty sure you'll remember. Some of you would be in the market. I actually started my career in 1999. So I clearly remember that losing my first year salary to this bubble. Okay. The bubble burst in 2000 as Fed started tightening the monetary policy in 99 and withdrawing the liquidity to address the bubble. Okay. So why it started in 1985 and not before that? In 1985, 1986, when Alan Greenspan became the Fed chairman, before that we used to allow the boom and bust to take place. Every euphoria has to go with after that has to go with recessions. Okay, there is a cycle which needs to play out. But by continuously injecting liquidity after 1987, we made sure that we do not get the proper recessions which we need to get. Excess liquidity leads to lower recession, but excess liquidity also leads to bubble created in some part of the world. So I've explained you till 2000, what happened till 2000. 2000 to 2010. Now post the tech bubble burst and amid 9/11 crash, I'm pretty sure you'll remember 9/11 crash, the Federal Reserve again started easing policy, which led to falling US dollar. This coincided with China's entry into the WTO, and ultimately both capital and factories started moving from developed market to emerging economies like China. This was the decade when emerging markets, including India, outperformed developed market. And then we had a Lehman crash. During global financial crisis, the Federal Reserve again eased the policy, but the dollar did not weaken this time. Why? Because US went through a shale revolution. But in 2010, US oil production was 6 million barrels per day. 2023, their oil production was 13 million barrels per day. So they went from 6 million barrels to 13 million barrels. That means US trade deficit came down. When US trade deficit came down, it was a beautiful period of disinflation across the world because oil prices were not going up. Oil supply had gone up by 6 billion barrels to 13 million barrels per day. So 7 million barrels were added per day in US alone through shale. Their terms of trade became better, and the dollar became much better because the trade deficit was refusing to go down. In a disinflationary world, this time the money moved into tech. Now, tech bubble actually burst last year, but that tech bubble got a lease of life due to AI. Now, I believe that as soon as the Fed starts cutting the rate, this money will start moving again to some part of the economy, some part of the world. And this time I believe that this bubble will be created in parts of in India, Latin America, Africa, Middle East. Money is going to leave the Western world, indebted Western world, where policies are, the policies are no more consistent, to some part of the world which is providing much better growth. And that is why I believe that once this bubble burst of AI related, tech related bubble, which has just got a lease of life due to AI, the money will start flowing to other parts of the world. So that is what is the whole history of the bubbles. It has been created only because of we not allowing recessions to take place. Our monetary policies do not allow recessions to take place anymore. Every time small thing happen, we just inject new money into the system. And since new money is injected into the system, it has to go somewhere. It goes somewhere, creates a bubble, and then that bubble pops. Friends, unfortunately, I've taken a
So,
lot of time for this
so
thing.
no, that's good, Ritesh. So, is it like fair to assume that bubbles are not always bad, and if we are on a trajectory of making of a bubble, so the time period till we reaches that would be a golden time for the markets? Is it a right assumption, or there are some nuances to it?
No, it's a very simple assumption. There is no need to overthink all these things. Now, there are two ways of looking at this thing. Either the bubble is created in a very short period of time, very short period of time, like 1985-87 was Japan. Very short period of time, the bubble is created. So let me give you a couple of examples over here. Okay. Let's say over the next 3-6 months, huge amount of NRI and FPI money comes into India. We already have the retail money coming in. The valuations goes out of the whack completely, and every day what we are talking about, huge amount of money is coming to the market, creating new highs. Okay, it is completely delineated from the fundamentals. Those bubbles burst really fast. Anything which goes into a parabolic trajectory, bubble, burst really fast. The other way out is that our policies take away some of the speculation from the market. So the money can either go to financial market or the money can go to real economy, creating jobs and creating capacity. I believe our policies are going to incentivize production over consumption in the coming months. And that means slowly the speculation will be out of the market. Over the next 12 to 18 months, it is possible that our markets flatten out because policymakers will make sure that the money moves from financial markets to real economy. Real economy starts picking up, job creation starts picking up, and in 12 to 18 months, we'll be talking about that this bubble can then can have a much more longer life. Okay, getting my point. Either you can have a parabolic bubble which bursts very fast and very badly, and most of the people are caught in that bubble. The other one is you make the life of the bubble longer by moving money from deflating the bubble slowly, moving money to the real economy, letting fundamentals catch up to the bubble, and then the bubble has a longer life. We will come to know in the next 2-3 months where
Right,
we are. But all
right,
bubble burst
Ritesh.
up, all
So,
bubble bursts. That is historically, that has been proven.
right. So historically, if we say gold, it has underperformed the equity classes, but these days, as you also talked about the new global world order and gold being talked about as a reserve currency. So how things are going on and how they can shape even from here, would appreciate your view around that.
There is only one reserve currency, honestly. That currency is US dollar. Why? Because in a fractional banking system, only a paper money can be a reserve currency. What is happening is after Ukraine-Russia war, when Russia's foreign exchange reserves were confiscated, okay, from that time onwards, every country started feeling afraid about keeping their FX reserves, which is dollar denominated, in a bank, in a US bank in New York. That is how you keep your US dollar balances. Okay, you do not keep the US dollar balances in India, you keep it in the US. If tomorrow, let's say India is on the wrong side of the US, what does that mean? That US can just confiscate India's $600 billion lying over there? So due to that particular reason, 2 years back of Ukraine, Russia, more and more countries have started investing their incremental FX surpluses into gold and including other things. Now, why are they doing it? So I'll give you a small example. China buy oil from Saudi Arabia now. Saudi Arabia takes that CNY and uses that CNY to buy Chinese goods and services. Now, it is possible that Saudi Arabia has exported a lot more and has imported a lot less. It is left with CNY. CNY is not a reserve currency, and honestly, even I will not believe in CNY. Here comes China, says that on Shanghai Metal Exchange, you can buy gold. They have gold contracts over there. You can buy physical gold over there. They tell to Saudi Arabia, you can buy physical gold and you can take the possession of that particular gold and take it back to Saudi Arabia. So have you seen how we have bypassed US dollar? We have introduced two currency where Saudi Arabian Rial and Chinese Yuan. You are trading amongst each of them, and the net settlement, the net cash, is being used to buy gold. It's a very simple thing which is happening now. All because everybody wants to bypass US dollar. Now look at India's trade with Russia. I'll go back to a little bit 15 years back, where I remember when I was on FX trading side, that India imported some oil from one of the countries sanctioned by US. Now, since India cannot use SWIFT to pay dollar to that country, India actually opened a INR account of that particular country in India known as Vostro account. So Nostro account is where Indian banks keep their dollar reserves outside India, and Vostro account is where foreign countries and foreign companies keep their INR account in India. Okay, so India actually credited the equivalent INR amount of that particular bank, okay, where that particular foreign country had opened its bank account. That bank was sanctioned so heavily by US at that point of time, and it was not allowed to open any branch in US, and it was cut out from the global banking system. 15 years back, it was like that. Today, RBI has just allowed 37 more banks to open a Vostro account. Now, what we will be doing is, whatever net settlement which will be coming, that will be coming in the form of gold. What China is doing, I believe it's a matter of time. India will also be doing the same thing, where obviously nobody believes in Indian currency as of now, because whether we like it or not, it is not the reserve currency of the world. Okay, but can we offer the net settlement in the form of gold to foreigners who export more to us and import less from us? So that is why gold is coming to the system as a neutral reserve currency, and as Luke Groman says, it's a BRICS own currency is actually gold.
Great, right. So there is one question on this from audience in the comments. He's linking Bitcoin also. So he's asking, can you please explain the Bitcoin versus gold dynamic in the current global political economic construct? Will Bitcoin be seen with the same suspicion as US domiciled assets?
My understanding of Bitcoin is very limited. Okay. So I cannot answer the question of Bitcoin or cryptocurrencies at this point of time, but I can answer in a completely different way. I remember in 2004, when first gold ETF was launched, GLD is the name, gold ETF, GLD. That time, as soon as the gold ETF was launched, it became an institutional asset with worldwide adoption. The same thing has happened this year, where first Bitcoin ETF has been launched, and now you know that there are 10 Bitcoin ETF, including the BlackRock Bitcoin ETF. I believe Bitcoin now, after the launch of its ETF, is going to have a massive adoption and is going to have a more institutional framework around it, giving it legitimacy. The day ETF was launched, it became a legitimate asset.
And Ritesh, till last month, there was uncertainty around the elections, and that happened. And we believe that we are on a path of policy continuity, right?
Hmm.
So, in global parlance, do you see India stand out as far as policy continuity is concerned, or there are other places also they are, doing well on the policy continuity thing, and how important and it would be in the sense obviously from Indian market point of view, and otherwise also the importance of policy continuity in general.
Okay, I will actually reply over here. This is why I'm saying India will become a bubble. In my presentation, India becoming a bubble, actually there is a slide where you have G7, leaders of G7, and all of them are on their way out. Their policies are different than the policies of their successor. I'll give you a small example. Till the time Angela Merkel was there in Germany as a leader, they had adopted nuclear as policy. After the new government has come in, they have actually dismantled nuclear as a policy, and unfortunately, they're bringing back coal. When Mr. Rishi Sunak was the prime minister in UK, they actually gave a drilling permits in North Sea for oil drilling. Yesterday evening, after the Labour has won the election, that policy has been changed, and all those leases are going to be cancelled by the Labour government. When you look at that particular slides of G7, you find that in all the countries, there is a change in leadership. Change in leadership is due to because of different parties coming to the power. Whenever different parties come to the power, it leads to policy uncertainty. So much so that now the people who had got the leases in North Sea to drill oil are now going to sue the Labour government in UK. Nobody wants to invest in those countries where there is a policy uncertainty. In India, you are having the most important thing, which is the policy certainty. Now you would say, why is the government important? After COVID, government is the economy. Just, you know, understand the statement what I'm saying. In Western world, 40% of the GDP is due to government expenditure. In India, it is between 28 and 30%. So 1/3 of the economy is dependent upon whims and fancies of the government in India, whose policies continue to be stable. Whereas in the rest of the world, the big boys, where most of the capital is, 40% of the economy is dependent upon the government. So any change in government policies, which you know might happen in US also, investors don't like. And that is why having the continuity in politics in the government in India is actually a very, very big thing for India becoming a bubble, because investors do not like policy uncertainty.
Great, sir. And coming to a very important aspect like Indian exports, in certain sectors we are seeing the traction as far as exports are concerned. So, not specific to India, but I want you to draw a parallel if there is any between China and India, where we are positioned if we talk about of China, say of the late 90s or early 2000s, if there is any nuances to it.
India's per capita GDP is $2,500 and China is now closer to $10,000. They have actually vacated the low-end manufacturing or assembly. Very simple. There is one more thing which we are not keeping in mind over here. Actually, Vietnam was in spite of such a small economy, it was the darling of all those electronics companies out of Taiwan and South Korea. Now, when you look at Vietnamese dong or Vietnamese, the economy is in a bad shape due to a lot of frauds which have taken place in the last 2 years. So India is getting two things over here. India, just because China is vacating the low-end manufacturing and moving on to the high-end one, which you can see it in their cars, whether it is EV or ICE, India is getting that space which is vacated by China, and India is getting more space which belonged to Vietnam. Vietnam was actually the first choice of Samsung, LGs, all these from Taiwan and South Korea. It was the first choice, not even China. It was the first choice. Now that part of the work is also coming to India. 7 years back, I remember Apple was making refurbished phone in India. This year they'll be making $8 billion, and $8 billion of phone will be made in India by 2028. Their own target is $40 billion. So India is getting a very clearly a space which is on electronic side. I'm actually noticing it on the toy manufacturing. I'm noticing it in defense manufacturing, where we are doing more indigenization. So yes, you are absolutely right, and it is happening not because we are better than China. China is vacating those spaces. They're $10,000 per capita GDP. Their wages have gone up. They are moving into the middle income bracket. They will actually make value-added thing, and whatever is not value-added, it comes very easily to us because of our low labor cost, and that is what we are doing. And that is what is even required because we have 1.4 billion people. We have very high unemployment. So that is the best of both the worlds.
So, Ritesh, the manufacturing and infra growth, if we talk about in comparison to the GDP, do you see any increase in comparison to the past? And if there is any, so what is the quantum of that, and how much growth we can foresee from here, if there is any idea around that?
There is a slide actually which I have put. Okay, I have it. Where when there are some countries which have actually gone through this period, where manufacturing at the start of the of a period, let's say in Thailand between 85 and 91, manufacturing at the start of the period was 21% of the GDP. By 1991, it was 28% of the GDP. China is the best example. Actually, let me go to Vietnam, because Vietnam is, these are the ones which are even vacating the space. At 2010, Vietnam was 19% of the GDP used to come from manufacturing. 2022, 25% of GDP used to come from manufacturing. India, the starting point is 15%. Now you can all put your numbers. I have put some numbers. India's nominal GDP in FY23 is $3.3 trillion. I believe by FY30 it can easily reach $7 trillion. Okay, there is a consensus over there. Manufacturing GDP, which is $453 billion, can easily go to $1.3 trillion. So I'm talking about 2x in nominal GDP and 3x is not manufacturing GDP. So manufacturing, which is as of now at 15% of the GDP, even if it goes to 2021 in another 7-8 years, we are talking about massive wealth creation from that part of the market, which is not even in the index. Can you see what is happening over here? Right? All because I'm not saying services will die over here. I'm saying services will continue. But services will continue at the pace which they've been continuing. The incremental delta will come from manufacturing.
And Ritesh, as far as job creation is concerned, so in one of your video, the link to which I have pinned to the spaces, you mentioned that job creation will be a game changer, right? And you also talked about when there is an increase in manufacturing, it provides more jobs, and that leads a cascading impact. So, would appreciate if you talk more around that.
Yeah. So India never had physical infrastructure, but India had digital infrastructure and English-speaking, population. So we leapfrogged manufacturing and went directly into services. You'll be surprised to know that there is no other comparable example in the world. Why? Manufacturing creates 5 times the jobs created by services. But since we were not having physical infra, we were having English-speaking people, and the cost of internet, cost of digitization was very, very low. that we had more people were pushed into services. We directly leapfrogged in manufacturing and went into services. The problem with services is what we are having is jobless recovery. And where do these people who got jobs in services stay? They stay actually in urban areas. So, so what you found was urban areas did well. People who were in service sector did well. Services at one point of time was 65% of India's Nifty benchmark. But what it led to? It led to a lot of difference from rural areas, between rural areas and urban areas in the form of wealth. Now, we've created a physical infrastructure over the last few years, and that is a basic necessary condition for you to create manufacturing. As I'm again going to say, and I have not taken impact of AI into account because I do not know, manufacturing creates 5 times the job created by services. Where will all these manufacturing units come? These manufacturing units are not going to come into the heart of Bombay, Delhi, Calcutta, Madras. They are going to be away from those centers, but wherever there is a good infrastructure. So what you are finding is the prosperity is actually, incremental prosperity is actually going to move from metros to non-metros. I'm pretty sure you can see that, in Bombay, real estate prices are stagnating for the last 7-8 years. In Delhi, it is happening the same thing. But some part of tier 2, tier 3 town, and I'm writing for last 2 years, that those tier 3 towns, it will boom wherever all these manufacturing capacities will come. Think about people who were not having jobs, even start getting, for an Apple assembly, they start getting 25,000 and 30,000 rupees job. This is going to be a complete different thing where you create jobs, all these manufacturing capacities away from the cities, and incrementally over the last 2-3 years, aren't you seeing in your benchmarks that the weight of couple of sectors itself is actually coming down slowly, and some other part of the benchmark is actually going up? So this is what it is, because without manufacturing jobs, you will have a social revolution in India. We need to give jobs to people. India is having the best demographics among the large economies. But what is the point of having demographics if those people cannot be given jobs? And that is why I believe over the next few years, the incremental focus should be either GCC in services or manufacturing.
Right. So, Ritesh, at this point in time, what is the situation of fiscal consolidation and how government is progressing on that front? And if we can make a comparison, the government capex, or if we compare it like, will it reduce, or that is going to be as it was there in the last 5 years per se? And also, if you can throw some light on primary balance, my understanding is limited, but Rhythm Desai talked about achieving primary balance in one of his recent interviews. So, if it is related to it, I would appreciate your thoughts on that.
So let me talk about fiscal deficit. When India was at 3-4%, rest of the world was lower than that, and India used to come out in a very bad picture. Today, let's say India is 4.5 to 5%. I'll give you between India and US. We don't need to go to other parts. Other countries are in a worse shape. India's economy growing at 7%, having 5% inflation, with a fiscal deficit of 5% and debt to GDP of 90%. Okay, just some number throwing, but just take this thing on. Indian economy growing at 7% real GDP, 5% inflation, fiscal deficit of 5%, and debt to GDP of 90%. Let me compare US to you. US is growing at 1.5% with an inflation of 3 to 4%, fiscal deficit of 7%, and debt to GDP of 130%. Europe is even worse. Canada is bad. Ultimately, it's all about comparison in life. Any economy which can grow fast should never be worried about debt to GDP, because you can always inflate away the debt. Countries, Western world countries, will not be able to inflate away the debt. If you cannot inflate away the debt, your future GDP actually is lower. In India's case, future GDP, if they can continue to have 6 to 7% GDP, I'm not, I'm not concerned about, having a debt to GDP of 80 to 90%. Okay. So look at it in this particular way that we have the best macroeconomic indicators across the world. And I'm including Brazil, Mexico, Saudi Arabia, apart from the G7 countries. So that's why I say that any country which can like real GDP of 7% plus inflation of 5%, 12% nominal GDP, you will not find in any other part of the world. That's why the premium which is paid for Indian assets are actually justified. Now coming back to the current account balance. Our current account balance, and I have to compare it to 2005 to 14 cycle because that was a capex cycle. Okay, at that point of time, the current account balance was around negative 2.5% of the GDP. Today it is negative 1% of the GDP. Okay, I'm not taken into account the primary balance. I have to look at the number. The barrels imported, oil to GDP ratio is a very important one, which Morgan Stanley actually came out with. Oil to GDP, our oil intensity per unit of GDP is actually down 30 to 40% from 10 years back. Okay. So all in all, when I look at the numbers, which is a part of the India making of a bubble presentation, slide 10 or 11, I have covered all these things over there. But I compare it to any other part in the last 20 years, and I find that today's macro, and please understand that any company, so I'll put an example of a company growing at 20%, then 10%, then 20%, then 10%, or a company growing at 15, 16%, with for 4 years. Where will you give a higher valuation? So 10 years back, India's macro used to be very, very volatile. From currency to current account balance to inflation used to be very, very volatile. So you couldn't take a long-term call on India or Indian assets. Today's India's inflation volatility, India's GDP volatility, India's trade balance volatility has actually collapsed. Whenever you collapse all these volatility, you can actually pay a higher premium for those assets.
Right, Ritesh. And if we talk about corporate profit to GDP, what is the current situation, and would it be wise to draw parallel with US? Like, what's the situation there?
Let's look at India's, because corporate profit has to go up if you want, all these valuations to be sustained. India's corporate profit to GDP ratio is at a 15-year high. Okay, the last time we saw this ratio, so it's almost 5% now, corporate profit to GDP. It went, in 2020, it went down to 2%. In 2007, at the height of the last, just before Lehman crisis, it was 5.2%. India's corporate profit to GDP is actually improving year over year. So yes, that is also improving. It's not in air. So ultimately, every bubble requires some fundamentals to be around with it.
And Ritesh, like, if we have to grow as an economy, in that case, the power requirement and especially the focus on clean energy is going to be huge. So, do you agree that these pockets will be certainly making good money to the investors, or I mean, you have a different view on these pockets?
Well, without electrification, we cannot even grow. There are 4 things happening over there. Services do not require so much energy intensity as much as manufacturing. So this is manufacturing. You want manufacturing? You need to have a proper energy policy in place. Okay. Second thing, EV. You want a green and clean energy? Fine. You have solar panels. You can use EV. But all of these need proper grid, connectivity to grid. How old is our grid? Actually, I know US grid is 40-year-old. So unless all these assets can be created to put all these energy can be put to the grid, it is of no use. Nuclear, we have not created new power plant in the last 10 years, but we are having something coming up now on nuclear energy over there. Okay. Now we need to take into account the energy requirement due to AI and data centers. Today Maharashtra's, if I remember, 5% of entire energy is used by data centers alone. If we cannot create energy, proper energy, we cannot create proper grid, do not have the electrification policy, then whatever I'm talking about, the bubble will burst really, really fast because, yes, we want to go into that particular direction, but the basic minimum requirement for you to go into that direction is your energy security. There is not even a single country which is energy poor. There is no energy poor rich country. There are only energy rich countries. And that is why
So
nuclear
in
is
the
one of my biggest, I think now that with NGOs out of way, India is building the second largest number of nuclear power plants in world after China. And just for information, US is not even building any one.
So, Ritesh, if you talk about the value chain of power and energy companies, so where you believe that the profit pools are going to be concentrated, if any, I mean, you would like to say?
No, there is an entire ecosystem on which I will not be able to talk about.
Yeah, fair enough. So, from here, Ritesh, like broadly, how you see next 2 years panning out in the markets? If,
Okay,
in general, you can talk
so
about.
I believe that we are headed for a consolidation phase, 12 to 18 months of consolidation phase where we cool off this thing. I believe production will be incentivized at the expense of consumption, and people are actually talking about that thing, the taxes have gone up. The reason is, I believe India is now following the South Korean models of chaebol or Japanese model of kiritsu. What happened was, South Korea was a very poor country. Obviously, after North Korea and South Korea divide, it was still a poor country. Government tried to do a lot of things themselves. Some things worked, most of the things did not work, the bureaucracy did not work. They made 6, 7 champions where they said, we will give you the full support. You go, you make for South Korea and you take over the world. Whatever you require, we will give it to you. From Daewoo's to Hyundai's to LG's of this world. They actually made policies which promoted production at the expense of consumption. I believe India is following exactly the same model of development, where we are going to have 6, 7 champions. These 6, 7 champions will be there across different value chains, and India is going to actually curtail or bring out policies which will curtail speculation in the equity markets, because that is what the government does not want. Money, as I've said, money can either go to financial market or money can go to real economy. Financial markets, money will be taken out of financial market, some regulation, some taxation, and we will be put in real economy, creating capacities. The baton will be passed of capex from public sector to private sector. They will require money to create capacities and create jobs. So you will have a period where you will go into the lull in the market, 12 to 18 months, could be 24 months, which is required for you to cool off. You will have fundamentals which will catch up to the market, and then you will be having, nobody will be talking about that India is a bubble.
Right. So there is a good question from Tirth Shah. He's asking if India uses gold for settlement with Russia, then in which currency India will be buying gold?
Okay. So first of all, what is India doing? Have you seen that India's engineering exports to Russia has gone up by 130% year over year? India is importing oil from Russia, and we gave INR to Russia, which that Russian foreign minister Sergei Lavrov actually in public said, what do we do with this INR? The reason being, we cannot allow Russia to buy Indian assets with that INR. But we told them, you can take you can buy goods and services from us. So that's why you are finding lots of goods and services, lots of goods which are going to Russia. Russia trade is actually a very good example of Vostro trade, where so many of industries in India are now new winners because Russia has to buy from India against that INR in their account. So India-Russia trade has nothing to do with gold as of now. Gold trade is
Right.
actually happening as of now only in Shanghai Metal Exchange, where in China, in Shanghai Metal Exchange, you can go ahead. If Russia and China trade is there, Russia can go ahead and convert their CNY in, uh, can buy gold from Shanghai Metal Exchange and take it back to Russia. But it is not applicable as of now in India or India and Russia case. We are just telling them this is the INR. Use this INR to buy goods and services in India, and that is what it is. So whatever cash is remaining in that account, it is there as of now. I believe over a period of time that we will have more and more of, then at that point of time, we will have some gold settlement also, where we will tell them, okay, you do not want to buy gold, good and services from us, then you have to, then please take gold from us. Now, gold in Shanghai is at 3% premium to the gold in COMEX. That means more and more gold is actually moving from COMEX to Shanghai because people are paying a premium to buy gold in Shanghai to keep it in Shanghai Metal Exchange. So initially we will have to buy it in dollar only. I can see that thing, but I guess that it's too early for me to give you a definitive answer on that.
All right. So Himanshu Dubey has asked, "Hi, what are your thoughts on something more basic like high valuations versus earnings in Indian corporates? Is that a potential bubble waiting to be burst?"
The thing is all bubble burst. I'll tell you what it is. I'll give you a small example. If your company is continuing to grow at 25, 30, 35% earnings, I'm talking about, you can assign any valuation to it. As soon as that earnings normalize to less than nominal GDP, you cannot give them a supernormal valuation. So there are sectors which we'll come to know, which are still going to give you 25, 30% growth year over year. So I am not saying for the entire market, for a small part of the universe where macro is in favor, where I believe that over the next 4 or 5 years, these companies will be very big beneficiaries, or these sectors will be very, very big beneficiaries of what is coming in front of them. Then I think what will happen is you will go through a time correction. You will not go through a very serious price correction of more than 10-15% because you are having the liquidity and the fundamentals supporting that thing.
All right. Prakash R is asking, while most variables are in favor of India, our taxation is not. Do you see a situation where aggressive taxation by the government may not even allow a bubble to be formed?
Exactly, that's what I was saying. That they will do something, and in this budget, I'm pretty sure you will find that thing. We do not want. We are very clearly thinking of having a South Korean models where people work, we produce, we incentivize production, we disincentivize consumption, we disincentivize speculation. That will come on its own. I'm pretty sure that is coming.
Right. Right. So we got one speaker. Varun, you can unmute and ask your question.
Hello,
Varun.
hello,
Yeah,
Prince. I'm
yeah,
audible.
go ahead, Varun. Yeah, Varun, go ahead,
Okay,
please.
thank you for the opportunity. Actually, I wanted to ask Mr. Jain your take with respect to this RBI actions on all unsecured lenders, both rural and urban. Where is this heading, and do you feel it is justified? Thank you.
Justified, I do not get into justification of the government what they do. I'm given a set of variable. I make my views given a set of variable. The set of variable is government and RBI do not like what is happening as of now. Okay, on whether it is on the unsecured lending or whether it is on the speculation in the market. You've already said your regulators are telling you now. In the brave new world where governments and regulators are deciding winners and losers, listen to your regulator. It is their thinking process. My thinking process, my view has no meaning. It's their thinking process. They are saying we do not like this thing. And that means it will continue.
Right. So Nitin, you can unmute and ask your question.
Yeah, thanks, Prince. So, if we see the Nifty Small Cap Index after 2007 on monthly chart, the RSI oversold value is close to the same level which were in 2007. Okay, and the P also nearby same
Nitin,
actually. Yeah.
Nitin, I would request you to keep your question limited to the topic of discussion and make it crisp,
Yeah, yeah.
please. Yeah.
So, yeah. So after 2007, we saw the, kind of bubble burst or something like that. So similar, do we see similar, can we do similar analogy or this time the case is different? So that's my question.
I have enough data to prove that the fundamentals are different. I have enough data which tells me that, yes, 2007 was a bubble. It was an emerging market bubble. All bubble burst also. That is also reality. I believe that we are still not giving enough, not serious consideration to that India's economic structure is changing. Okay. And that means that new winners are going to be created over the next few years. Again, one more example, India, Russia I have given you. India has just given a 25,000 crore line of credit to another SAARC countries to buy goods from India. Use INR for their transactions if they want to buy anything. It is not dollar, it is INR. India is exporting Pinaka missile to Armenia. India is going to buy oil from Guyana. And Guyana can use that INR to buy goods in India. This is a new profit pool which is getting created in India. I'm not getting into that RSI part. I don't understand those part. I'm not a technical guy. I'm not a fundamental guy. I'm only a liquidity person. I'm saying that new profit pools are getting created in India, which has not happened before. These new profit pools are not part of the large cap indexes. You will find winners coming out of nowhere. And you will find what is happening. These winners are coming because of the new geopolitical consideration, because of the new thought process about manufacturing, because of China plus one policy. So many things are happening exactly at the same point of time. So forget about that RSI part. Follow where is a new profit pool coming. And that is where, irrespective of the market, that will continue to do well.
So there are one or two more questions in the
Yeah.
comments.
So the way you said, like profit pool. So in which sector do you see, such profit pools can come?
So I have been for the last 1.5 years, I've been writing on two things. Third, I've added. One is electrification, because I believe without energy, none of this is possible. There is no energy poor rich country. You have to be energy rich to become a rich country. This is one. Second thing is defense. Anything related to defense, and I'm more interested in defense tech rather than defense. The entire world is going to be arming again. All these countries in NATO have been told to up their spending on arms and ammunition. Unfortunately, they've forgotten how to make that thing. There are not even engineers left over there. Boeing is a great example to you. A lot of this work could have gone to China. Now, because of China, US are in cold war with each other, this work will come to India and already coming to India. This is going to create massive new winners in India. Third, the only sector where you can provide maximum employment in India and cut down on our forex reserve outflow is tourism. whether it is leisure tourism, whether it is medical tourism, or whether it is religious tourism. So these are the three sectors where I'm very, very bullish.
So, sir, if you see the declines,
Nitin,
yeah.
Nitin,
Oh,
there are others waiting. I would request.
okay, I will
Yeah.
keep very short. So the
So next in line is Kunal. So Kunal, you can quickly unmute and ask your question, and then Shashank.
Yeah, good evening, Riteshji. Quick question to you. Can you comment on, what you think will be the, GSEC yield trajectory in India going forward? Especially because you've said a lot about how you feel that global inflation is here to stay. So, are you suggesting that there will be a divergence between global yields and Indian yields? Thanks.
Yes. So Indian 10-year and US 10-year historically has been 350 basis point. You can draw a 22-year chart, you will find a 350 basis point. Okay, where are we now? 4.5 theirs. How much is ours? 695. Okay, 7%. 250 basis point. Actually, post 2022 Ukraine-Russia crisis, Latin American and emerging countries bonds have outperformed the developed countries bonds. And
Right.
that is what I believe that will continue.
Okay, thanks.
Yeah, Shashank.
Yeah, thanks, Prince. Hi, Ritesh. How are you doing?
Good, I'm good. How are you?
I'm very good. Thank you so much. So I have two questions. One on the energy part. Since electrification is definitely going to be a global theme, not just Indian. I just want to ask you, what do you think is a realistic spread between the renewables and the nuclear? That's number one. And the second question would be related the the when you look at the liquidity across US, Europe, and other parts of the world, how do you see INR appreciating, or let's say a dollar currency depreciating, dollar and euro? Because I think a lot has been linked. A lot of NRIs, living outside are, also, thinking a lot about this thing. So how do you see, relationship between INR and, let's say, Euro USD?
So first question I can answer because I have not thought through the answers. I have some data, but I would not be able to crystallize that into numbers for you. The second question is the easier one. Uh, INR CADI is at the same level what it was in 2014. INR has appreciated massively against JPY, sterling, euro. USD is the last man standing, and whatever said and done, US economy or US is the best, uh, the best shirt or the best economy in the G7. They're continuing to do well. Okay, 6 to 7% nominal GDP last year we saw. So that is what. But going forward, US has a debt to GDP of 130%. Historically, whenever debt to GDP has touched 130%, there have been 52 cases of, since 1800, there have been 52 cases of countries touching debt to GDP of 130%. 51 out of 52 of those countries defaulted on their debt by inflating away their debt. That means the value of their currency went down because they had to get out of debt trap. So this is a very simple way of looking at things. The only currency, modern day wonder, which has not followed this path is Japan. Maybe because they own their own debt. Having said that thing, US wants to industrialize again. This is after 2000. This is the first when they left when the jobs went to China. They want to industrialize again. The basic necessary conditions for you to industrialize and get investment from India, Taiwan, South Korea, or Mexico, some part of the world, is that you cannot have a stronger currency. You need to have a weaker currency. You need to inflate away the debt. So I believe India is in a far, far, far better situation than rest of the world. And Indian currency, which is already appreciating against other G6 currencies, will finally, in a matter of time, will start appreciating mildly, appreciating to stable against USD also.
Right. So can we say that this the consequential themes? Let's say, for example, the electrification theme first plays out, so that
Hmm.
US has used the stronger currency to reindustrialize themselves and the other
Hmm.
countries as well, and then further to that, we can see
Hmm.
this depreciate this currency depreciation and like rupee appreciation going forward.
Look, rupee can remain stable over here. What we've made rupees, we are making rupee a hard currency. We are not allowing rupee to move by a few paisa every day as a central banker. Okay, in 2 years back, India could not have done that thing. It would have been labeled as a currency manipulator by US.
Right.
Do we care about what US does today to India?
That's true. I mean, if you look at China, the way they depreciate the currency, and I mean, ROE का तो concept ही नहीं है उनकी country में. They don't
Correct.
even care about what the company is basically making or the shareholder is making. All that they do is depreciate the currency and just dump the goods.
Yeah.
So I'm just
But
afraid we don't follow that path.
we are changing something. Very interesting change happening in India. India used to have very volatile macros. People couldn't take a longer term call in India. Now, whether you look at your 10-year bond, whether you look at your inflation, whether you look at your currency or macros, your volatility has completely dropped, which allows you to have longer term calls and lower term premium to invest in India.
It's
That's what they are
interesting.
doing. They are compressing volatility in all asset classes and macro as it is happening.
So, in a nutshell, can we say that the majority of the assets are better off being parked in INR or gold?
Yes,
And gold, yeah. Okay.
yes. I would say, look, I'm in Canada. I would not keep anything in Canadian dollar unless there is a change in policies at the federal level. Canadian dollar, the only way for Canada to get back its mojo and get back its GDP is by sacrificing its currency.
Right. They're even putting exit tax. That's horrendous.
Yeah. So when you start doing all these things, this is what third world countries were doing. As I've been writing for some time, DMs are becoming EMs and some EMs are behaving like DMs.
Perfect. Well, thank you so much.
Thanks.
Thanks. Next is Sachin. Sachin, quickly make it fast.
Hey Ritesh, hi Sachin Mandot here.
Hey, hi Sachin.
So Ritesh, I think we keep speaking, but for the benefit of everyone else as well, what do you recommend NRIs like me who are in countries apart from US?
Actually invest in India growth story and through mutual fund only. Don't do anything. Don't do any exotic product. The best products available for investors is actually mutual funds, investing through mutual fund. I worked in a mutual fund for 20 years. I know what goes behind the scene, how much hard work gets to pick up, right companies for investors. But yes, there are enough different kind of mutual funds. I would say if you do not understand any other mutual funds, go in the funds where it's like flexi cap or, multi-cap funds for India, whichever is, you can get invest in a basket of curated by me on NRIZEN. Otherwise, you can pick up any mutual fund which you want. Just go for their multi-cap fund.
Thank you so much, Ritesh.
Yeah, thanks.
Great. So, Ritesh, more or less, we have taken all the relevant questions from the comments, and there were very thoughtful questions from our audience as well. So, I would request you if there are any concluding remarks to the session or anything you have in your mind which we haven't asked till now. So,
No, I'm perfectly fine. Actually, it's 11 o'clock in night for everybody in India. For me, it doesn't matter. It's 11:30 in the morning, but 11 o'clock in the night. I think we've covered everything what we wanted to cover. But I'm just saying, don't look at everything from what has happened in the past. Things are changing in the ground, but you have to read, understand what is changing and invest accordingly. But I strongly believe the best lies ahead of us. Either it can be a very short term if the government does not rein in these excesses. I believe they will rein in those excesses and move this capital from capital markets to real economy, giving a much longer runway to Indian assets.
Great. Thanks, Ritesh, for taking out time. It was really helpful for our audience, and there is always something new on table when we speak with you. And I request my audience to surely follow the YouTube channel. There are a lot of insights shared time and again, and definitely you'll cherish the global macro insights shared by Ritesh. And today's session is audio only. There you can also see various graphs wherein you are able to relate better. So I sincerely request you all to go through it, and you will definitely thank me later for that. So Ritesh, thank you so much, and definitely look forward to more such sessions as and when the situation and time allows. And our audience can surely follow him on his Twitter, because he's very active and shares his thoughts on Twitter as well. So
Thanks, Prince.
definitely please do that. Thanks, Ritesh.
Thanks. Thanks.
And